Welcome back to my channel, Balance Sheets Matter. Today I'm going to be doing a stock analysis on Kimberly-Clark, that's ticker KMB, but before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do stock analysis videos, so if you want ideas for potential stocks to buy or stocks to avoid, you should subscribe to my channel. And also, if you do want me to look at a stock, leave it in the comments below and I'll put it on my list potentially to do an analysis on it, because Kimberly-Clark was a subscriber requested video, so that's what we're doing today. So into the analysis, let's look at some of the high-level metrics. I always like to take just a glance at this Guru value band. Sometimes it's accurate, sometimes it's not, but it is kind of showing potentially, at least from the last several years, this could be a little bit undervalued, but as you can see, there's not a huge amount of variation in a stock like Kimberly-Clark. Also, the current PE is sitting a little high at 25.76, but the forward PE is substantially lower at just above around 18.5. And this is a nice dividend stock. A lot of dividend investors like it. It does pay a 3.78% dividend yield with a dividend payout ratio right now of 0.96. But because our forward PE is lower, the dividend payout ratio in the future will be lower as well. So let's jump into the financials here. So we can see basically their overall growth revenue trend. It gets these flat periods, goes up, flat, and analysts are expecting a little bit of growth in the future. But you can see over the last 10 years, it's been pretty minimal, averaging only 1.7% per year. EPS has been a little bit better at 4.7%. And I think this is mainly because they do some share buybacks. So let's jump into the financials. First, I like to look at the return on invested capital versus the weighted average cost of capital. Return on invested capital seems pretty good, but the problem with someone like Kimberly-Clark, since they aren't growing their revenue very much, that probably means they don't have very many investment opportunities. So while this is good, it's not very relevant, but the good thing is, at least if they do find opportunities, they've usually been pretty good in the past, and for them to get access to capital, it's pretty cheap for them, as their weighted average cost of capital is actually quite low. So now what do we see? We see on the revenue trend here. Well, the problem is with this revenue growth here over any period of time, it's really not anything spectacular. It's almost completely flat. We may actually want to even try to look at a little bit longer trend for the revenue here. So let's just, instead of 15 years, let's look at 20 years, just get a little bit basically bigger picture. And you can see they had a little spurt before where they had some growth, and then they basically plateaued over the last 15 years, which is not great. Gross margins there generally have been maintaining. They seem to hover between about 30% and about 35%, and right now we're right in the middle at 32.5. So this kind of does indicate they are able to keep that product pricing power, and they're basically not losing a competitive mode in that regards. And then we basically can see their operating margin, pretty much the same as the gross margin. It kind of fluctuates from the low teens to the high teens, and we're sitting right smack in the middle. So that basically means their selling and general admin expense is generally increasing at the same rate with the revenue. And if the revenue is not growing, it's relatively staying the same. You can see, for example, here back in 2010 and 2011, their selling and general admin was just around 3.7 billion. And what are we at around right now? About 3.7 billion. So this is speaking to some stability of Kimberly-Clark and the fact that we can tell they're not really losing any competitive moat. Next, I like to look at interest expense. They did start picking up basically some debt apparently in, well, I think they had it before here. It's just switched the lines, but they basically had this debt, which has been pretty stable. It's just usually around $300 million. And you know, that's for the amount of money they make, around 2.9 billion. This isn't the greatest interest to debt ratio. It's about this 1 to 10. It's not too bad. It's not terrible. Sometimes it's better. Sometimes it's worse. Nothing spectacular here, but they're going to easily be able to cover any of these interest expenses and take on more debt in the future if they need to. And then we basically come down. We see they've had net income all along the years, although it really hasn't been growing much. It fluctuates up, fluctuates a little bit down, and we see the same thing with basically the net margin. So pretty much across the whole entire income statement, we're just seeing this consistent, boring, really no big growth, but you're not losing the competitive mode. They're just able to kind of keep it steady, keep it going, and you know, that's what they're doing. And the one good thing is they kind of are buying back shares. So with this money they are making, they buy back shares and they return the capital to shareholders that way. And that kind of provides some of that EPS growth as time goes on. And I think the EPS growth, if I remember correctly, going forward is estimated to be about $7. They are in a little bit lower dip. So if you kind of do look at the longer trend, it is slowly creeping up. But you really got to realize this is really slow growth. This is not really anything spectacular. So Let's look at the balance sheet here. Right now, current assets sitting at $5.7 billion. Accounts receivable, they got some cash, and reasonable amount of inventory. It doesn't seem like they have any excess inventory. It's pretty stable throughout all the years, because that's a problem a lot of other companies are suffering from. And then their total current liabilities is sitting at $6.6 billion. So traditionally, this is not the best current ratio to have. It's a little bit below 1, but for a large company like Kimberly-Clark, this isn't really a big deal, I would say, but it isn't speaking to any great strength in the balance sheet so far. We can also see the total assets sitting at just around $17.4 billion, although there is just around $2 billion of goodwill. So we have to take that out when we're looking at their total equity, since goodwill isn't really anything tangible and isn't really anything real. And then we basically see total liabilities, $16.7 billion, leaving them effectively total equity of only $500 million. But remember, we have to take out the $2 billion. So really, the real tangible equity is sitting at negative $1.5 billion, which isn't that good. I wouldn't call this an incredibly strong balance sheet for a very mature, kind of boring company like Kimberly-Clark. It's just kind of average, but I'm not seeing any big plus points in their balance sheet. On the other side, I'm not seeing anything that's majorly distressing for the company either. Now, basically onto the cash flow. We can basically look at their cash flow from depreciation, and we can see it's been around, 800 million a year, sometimes a little bit more, sometimes a little less. And in comparison, the purchase of plant, property, and equipment is a little bit on the higher side. So this is one thing I don't like that much about Kimberly-Clark, is basically whatever they're depreciating and is basically being expensed that year, the replacement rate of the plant, property, and equipment is a little bit higher. So whatever you are seeing for their EPS and their actual earnings is in reality their cash flows at the end of the day, once we account for the purchase of plant, property, and equipment, is a little bit lower, because they're always having to spend a little bit more than they're actually expensing every year. But it's not too great of a difference like some companies like Intel. Also, there's been a few spotty acquisitions along the years. You basically had one little bit larger one for $1 billion in 2020, but other than that, you have one for $458 million in 2009. And even though they're doing these few acquisitions, the revenue still isn't growing. So that kind of speaks to that there's probably some decline in their product lines, and they do need to, do more acquisitions if they want to keep those revenues growing, since I don't know necessarily if they're going to keep growing naturally on their own. They might just maintain flat. And how do we see if they're returning capital to shareholders? You can basically see from the repurchase of stock here. In the past, they were repurchasing a lot more stock. Basically, since it looks like this has really started decelerating, even since 2015 going forward, and the last few years has gotten extremely low. So that's a little concerning that we're not getting as much return of basically capital shareholders through repurchase of stock, meaning it's really going to be hard for them to grow that EPS line basically by reducing the share count. But they do pay a healthy dividend, which has been going up over the years. And overall, this does look like a healthy dividend that they can continue to afford. So now let's jump into the relative analysis and kind of look at some of this and see kind of, what's their actual value looking like. So first of all, let's pop up the revenue with the analyst estimates, that is. You can see they are expecting actually Kimberly-Clark to grow their revenue a little bit in the future. It's, hard to say exactly what that's going to be from, but we can see the EPS here with estimate as well, which is expecting to grow a little bit and grow a little bit flat. But if we take out the price chart here, just to kind of get an idea, you can see this EPS trend over the very long term does very slowly creep up, even with fluctuations or not. So now let's take a look at their price to sales ratio, because overall their margins have been relatively stable from what we were seeing. So this can kind of tell us something. And you can kind of see is that over the thing, I'll just draw some lines here just so it's a little bit easier to see, but kind of a lot of the time you have this lower range, which is right about here, which is attractive. But there's also this period here during the great financial crisis where the stock did get significantly cheaper. So that always is that risk that something like that happens again. And then up here, I need to get this line here, is kind of the higher range of what the price to sales has been. And right now we're sitting at 2. It's getting a little bit on this mid-range lower side, but not particularly low. But also you have to realize that it could always get back down to these lower valuations down here. Let's also bring up basically the price to earnings ratio. Take a look at that. I'm gonna get rid of this big blip out here so it's a little bit easier to see. 25-year chart, and you can see this is the thing with Kimberly-Clark. They're a really slow growth company. Do they really deserve to basically be trading at a 25 PE or even with an 18 forward PE? When you look at the past here, during this whole period of time, they're trading at under 15, and a lot of other similar peers with similar balance sheets and slow growth, I think that's more a realistic value for Kimberly-Clark. Even back here in around 2003 and that, they're trading just a little bit above 15 or just below a 15. And that's kind of one of the problems I have with Kimberly-Clark right now is relatively for this kind of company, the price to earnings ratio, the price to sales ratio, the overall valuation does seem a little bit rich for them. And that doesn't mean they're necessarily going to go down unless there's something that happens like a big event that's really going to hurt the economy or something that's specific to them. But you always have that downside risk, and really right now very limited upside potential other than collecting that dividend. We can also basically pop up their dividend yield and get a relative kind of dividend ratio yield here, just kind of see how it was historically compared against the price. And what do we see here? Well, we see obviously it was a good time to buy when we did get up to similar dividend yields in the past, although it has gotten a lot higher in the past before. So, again, what is that telling us? Well, we could be approaching a good point to buy it, but on the other side, there is potentially a lot more downside. So let's look at the chart here, and that's what kind of my little technical analysis chart shows here. Let's just zoom way out and just kind of, look at the stock. You've had these this big up run, and then they've matured. And what happens? You kind of get a little bit more expensive, and the stock just traced sideways. And this is when it was extremely cheap, and it's not like it had a big crash. It just kind of chopped sideways into that. And where we are right now with the valuation and everything, that seems very likely what could happen, that the stock just might basically, just chop sideways, potentially for the rest of this decade. You'll be collecting your dividend, but I don't really see any big capital gains that could be made off it. And this is one of the reasons I'm not very interested in the stock right now. Also, just from a technical perspective, if something, black swan event were to hit Kimberly-Clark, you're probably looking at going down to around this $62 range, because they're, that would justify a lot lower PE, a lot lower price to sales. And this is kind of where your technical support as well, which, would make sense. We go back to this chart here, and I'll just kind of show you that. You look at basically the price to sales ratio. What are we sitting at right now? We're sitting at about a 2. Would it really be that unreasonable like in 2009 when it got to a 1? Like, it is very possible, and that's the risk I see in Kimberly-Clark, is the price to sales ratio and the price could be cut in half in a very black swan type event. But on the upside, you're dealing with very limited upside other than the dividend. I think there's a lot better investment opportunities out there. I'm not investing Kimberly-Clark, but possibly if it did dip down enough, I might actually consider it. So I hope this gave you some insights on Kimberly-Clark. You like the stock analysis, make sure to subscribe to my channel, like the video, and I'll see you in the next stock analysis video.